Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Psigma's Tom Becket to discuss the last 10 years of investing, marking the 10-year anniversary of the beginning of the global financial crisis. Hello, Tom.
Hi, Emma.
So 10 years ago, we were in quite a good place sentiment-wise, not knowing that around the corner, the global financial crisis was about to hit. But let's propose that you held your nerve and you didn't take any money out of the market, as many people did, and that you'd ridden the waves over the last decade. Which have been the best performing investments?
Yeah, I mean, I think if you'd have just stuck with the positions that you had in 2007, you'd almost certainly not be sitting here, you'd have been fired, because there was such a big drop in asset prices in 2008 and the start of 2009 that if you were savvy enough to do anything, you probably sold when assets looked expensive in 2007, then bought them back cheaper 18 months to 2 years later. Now, not everyone did that, and in fact, one has to admit that with your investment strategy, you still held on to assets throughout that period that probably dropped significantly in value. But what you'd find now is actually the best performing asset classes have been some of those which perform worse, actually, counterintuitively, in 2008. Things like global credit, US high yield credit would be a mainstay feature amongst the best performers, and European high yield credit, despite what's happened in Europe over the last few years. In addition, US equities, which were obviously significantly overvalued in 2007, hit hard in 2008 and 2009, but have recovered extraordinarily strongly, nearly 300% since the depth of the financial crisis, making them one of the best performers the last 10 years. So I think if you'd held your nerve, it would have been a very rocky time. If you'd bought astutely in 2009, you've probably had a wonderful last 7 or 8 years.
And what about the worst performers since then? Because it's really shaken down into two camps, hasn't it?
Yeah, no, I think that's right. And I think back to 2007 and into 2008, those things which were most on vogue back then were probably things like commodities and emerging market equities. If you think back to the commodity bubble that we saw in 2007, 2008, that encompassed everything from oil all the way through to soft commodities, because China was going to buy the world and they wanted exactly the lives that we had, and those things might well be true, but it took longer for those trends to play out. They obviously had an incredibly poor time in 2008, recovered somewhat until 2011, and then have struggled ever since then. So commodities are probably amongst the worst performers. Emerging market equities are symptomatic of the high levels of volatility we've seen in the last decade, very much on vogue, absolutely hated, absolutely on vogue, and for the last few years until the start of 2016 hated once again. But they'd be towards the bottom on a passive basis of those things which have done badly in the last 10 years. And contrary to the massive amounts of enthusiasm and I think the complacency towards European equities we're seeing now, European equities were very much in the doldrums by the end of 2015 and now started to recover. But I think they'd be bringing up the rear of the equity markets that we've seen in the last decade. So I think most assets have performed pretty well in the last 10 years. It's been a rising tide floats all boats rally, but certainly there's been winners and losers amongst the main asset classes.
And how much of those winners is down to central bank policy? Because you seem to be commenting there that quite a lot of things that pay an income have done very well. Developed market equities, with the exception of European stocks, have done very well. Is that all due to sort of the global volume of quantitative easing that we've seen across the market? I
think you put it down to a number of factors. Let's be completely honest about it. Assets have performed well over the last 10 years, and in particular since the bottom in 2009 and more recent bottoms in some asset classes at the back end of 2015, because certain assets were cheap. Let's bring it into a sort of more shorter term context. 2016 was a great year for emerging market equities, emerging market debt, European equities, US high yield credit, commodities. Why? Because those assets were cheap. And actually look back to 2009 and we were in the same sort of place back then. So valuations have played a part in that. Likewise, the global economy might have gone through a sort of Nike tick recovery, big drop and a really quite slow truncated recovery there afterwards. But the economic conditions have been getting better. But I think you quite astutely pinpointed the main culprit or the main positive driver behind the returns of the last few years, and it's undoubtedly been the aggressive and hyperactive activities taken place by the central bankers around around the world who've inflated most asset prices, all the way from financial assets to, I would say, things like footballers' prices, through pumping the economy with loads and loads of cheap debt and really trying to cure the global financial crisis's worst ills, the debt bubble, with yet more debt. And I think that's the thing which would make me most worried at this point in time about the outlook. Many assets have been inflated because of the central bankers, and really the whole free market equilibrium of trying to find an asset market's right price has been distorted by their actions. So no small part, it's been down to the central bankers.
And now that they are unwinding that, or indeed promising to unwind that, does that mean that we will see a reverse in fortunes? I think we've already started to see it. You mentioned that European equities have started to come back into favour and indeed rise in value. You've mentioned emerging markets over the last year have started to do the same. Yeah. Should we expect the losers of the last 10 years to be the winners of the next?
Yeah, it's a difficult question to answer because we really are now in uncharted territory. But the US Federal Reserve and the European Central Bank and the Bank of Japan, the three biggest contributors towards global QE, are about to pursue different courses of actions if you take them at face value, which I don't. But let's just assume that the Federal Reserve are going to start quantitative tightening and put up interest rates. I think that will be a more difficult environment for US assets, certainly yes. And I think that some of the easy money will start to come out of those assets. Now, the question that you quite rightly ask is, will that money then start to find its way into Europe, into other parts of the world? And I think it has done already. But I find it very difficult to make an argument that even assets in Europe are cheap at this point in time. Actually, European equities aren't cheap, and there's a lot of complacency. And European high yield, as an example, now has a yield on the index of about 2.1%. We're talking about European junk bonds. That's a yield below that of US Treasuries on a 10-year type bond. So I'm finding it really hard to find value, and I find the central bank argument of loose money very difficult now to justify as a reason to be very on risk in your portfolio. If you can marry up central bank actions with cheap valuations like we could at the start of 2016, then by all means, take a lot of risk, be very on risk, try and buy assets that are cheap. Now, 18 months, 20 months forward from a wonderful buying opportunity at the start of last year, I'm finding that really difficult. Whether or not the central bankers actually do retract their quantitative easing programs, it's a very difficult investment environment out there.
Tom, thank you very much.
My pleasure, thank you.
This is Emma Wall from Morningstar. Thank you for watching.